Now that you know that mutual funds, or rather what mutual funds are, let's shift our focus on another type of investment fund called the exchange traded funds, or ETFs. So many of the basics about ETFs are similar to mutual funds. They're both pooled investments that own several different asset classes and offer the same benefits like diversification, convenience, professional management, and other benefits we spoke about in the last video. So the main difference between both these investment funds though is ETFs trade like stocks on stock exchanges like Nasdaq or the New York Stock Exchange or any other stock exchange discussed in lesson 6. So while mutual funds are priced and allowed to be traded once a day, ETFs are traded all day, allowing the prices to fluctuate freely on the market. More often, ETFs track a specific index like index funds do. In fact, one of the first ETFs to be created and traded on the American Stock Exchange tracked the famous S&P 500 index. This ETF, which goes by SPDR, which some people commonly dub as SPIDER, is still one of the most actively traded ETFs in the stock market. Then again, there are also other ETFs in which the investments are made in securities like equity, fixed income, or hybrid mutual funds. So there are other options available as well. Now that you have a basic understanding of how ETFs work, let's do a detailed comparison between mutual funds and ETFs to see which type of investment fund is better to invest in, especially during a recession. So before we get into the detailed differences, let's do a quick run through of all the similarities between both these types of investment funds. One, they're both pooled investments that offer an investor exposure to a multiple array of investments at once. Two, they're both great investments for diversification. So that begs the question of where do they differ? Well, firstly, in pricing. With mutual funds, the prices are set only once a day after the market closes, while the prices of ETFs continue to fluctuate in the secondary market throughout a trading day. So, in other words, with ETFs, you will at least know the price at which you will be buying and selling your ETFs, as opposed to mutual funds, which you will need to wait on the prices of the market to close. Now, the price fluctuations within just a day wouldn't generally be much for a mutual fund. But during a recession, of course, you can expect a fluctuation to be much higher than usual, meaning the uncertainty and the risk rate will become much higher. Since ETFs take this unpredictability off, this to a certain extent is a better bet than the ordinary mutual funds during a recession. The secondary difference between the investment fund is something that we've already discussed before: the number of times the funds are traded. So mutual funds are allowed to be traded only once a day, while ETFs are traded throughout the day until the market stays open, which means ETFs are relatively more liquid than mutual funds are. You already know how important it is to have liquid assets during a recession in case you want to quickly cash out. And since ETFs offer this, it's better than mutual funds as well. ETFs make a better recessionary investment than mutual funds. Another factor that differs between mutual funds and ETFs is how they are traded. Now, you may already know you trade mutual funds, or rather how you trade mutual funds, by purchasing and selling them directly through the company that manages the fund or through a broker. ETFs though, since are traded like stocks do, require you to get started in the same way as stocks. All you need to do is find yourself a broker and trade, either through buy and sell orders or through an online trading platform. For both options, however, you will need to do your research on whether the companies, be it a fund managing company or a brokering company, are essentially good. So this particular factor doesn't have a significant impact on investments which are better. It's just the same as what we discussed a little while ago. See, since ETFs can be traded anytime and offer better liquidity, it's a better option during a recession. Then there's also a minimum investment factor that differentiates mutual funds and ETFs. So generally, to invest in mutual funds, you'll have to invest a flat minimum amount, like let's say $3,000 or $5,000. The amount differs from company to company and fund to fund, but usually a policy like this is always in place. ETFs, on the other hand, have no such policy. You can buy an ETF for the price of just one share. Now, if you have the money and intention to invest a specific amount of money that is higher than the minimum requirement in mutual funds, this might not make a big difference in which investment is better. But for others, ETFs might seem better, since with no minimum requirements, it makes it a much more accessible investment regardless of whether there is a recession or there isn't one. And during a recession, the zero minimum requirement makes the investment even more better, since you don't have to invest a lot of your money in the same place. There is also another factor you need to analyze before choosing an investment fund. That is, which is the management style of the fund. So both mutual funds and ETFs, as you already know, are pool investments that are managed by a fund manager. Now, how this fund manager manages this investment portfolio is another thing that might make one fund better than the other. But this is not really a comparison between mutual funds and ETFs, rather a comparison between mutual funds and ETFs that are managed in one way versus mutual funds and ETFs that are managed in another way. So the first management style is the active management style, and the second is the passive management style. Now, active management style is, well, actively managing the portfolio. So to be precise, in this investment style, the fund manager will monitor the market. They will make predictions on how the market might or might not move, and constantly change the portfolio accordingly to make a very high return. The fund manager basically tries to outperform the standard performance of the investment market. That is, to elaborate on that, let's say that data shows an investor who invests in the S&P 500 can earn a return of 6% per annum on average at a given point in time. So ideally, a fund that tracks the S&P 500 index should also earn a return around that number. Now, what active managers do is they try to earn a return that is higher on that standard, maybe 6.5% or even 7.5% by actively managing that portfolio. Fund managers who use the passive management style, on the other hand, don't go through all that hassle. They simply aim to match the performance standards, the market benchmarks. There are no hard rules that mutual funds have only one management style or ETFs have one. Both funds can be managed in either style. But mostly a majority of mutual funds are actively managed, while index funds and ETFs are generally passively managed. As to which management style is better, well, you need to know a few things before I can tell you which one is better. First is the expense ratio. We will be getting into expense ratio in detail a little later in this video, but for now just know that the expense ratio is the percentage of your fund investment that you pay out as fees and other charges. So when it comes to the two management styles, the expense ratio of actively managed mutual funds is generally higher. They go as high as 2% of your total investment, not the gains, because the fund company claims that they need to be compensated for all the effort they put in by the fund manager. Passively managed funds, on the other hand, don't generally entail an expense ratio as high as actively managed funds do. So it is definitely a much cheaper alternative. Now, I understand if you think that although actively managed funds are a little expensive, they at least try to make a higher return than passively managed funds, and that makes actively managed funds a pretty good investment. But here's the deal. Actively managed funds, although try, have a very low capacity to beat the market returns. There's actually a very interesting real-world bet that happened on this. So you know Warren Buffett. He always held this notion that active managers can't beat the market returns no matter how much they tried. And once, in around 2007, he even made an open challenge to the US hedge fund industry, where he said that no hedge fund company can outperform the returns of a simple S&P 500 index after fees in 10 years that followed. If a company did, then Warren Buffett was going to pay them $1 million. Warren Buffett tried to make 2 points here. The first is that active management doesn't work the way fund managers claim they do. And second, even if they did, the fees charged for active management itself eats away a significant portion of the returns. Anyway, there was a fund management company called Protégé Partners that accepted Buffett's challenge to actively manage a portfolio to beat the market returns. 9 years after that, not even 10, Protégé Partners simply gave up on the challenge, because at a time when the simple S&P 500 index fund made a return of about 85%, the actively managed funds of Protégé Partners managed only 22%. Can you even believe the difference? So really, actively managed funds are just a costly investment with very little returns, and there's absolutely no way that counts as a good investment. Passive styles, though, which is the case for most index funds and ETFs, is comparatively much better because for a lower cost, they perform pretty decently. The last factor that we're going to take a look at here in our comparative analysis of mutual funds and ETFs is tax efficiency. Now, this is something that varies from country to country, but in general, if you take ETFs, if investors who have invested in the same ETFs as you decide to redeem their funds, all they will have to do is to go into the stock exchange and sell it. Since it's traded freely like stocks in the stock market, finding a buyer wouldn't be a problem for those who are looking to sell, meaning the decision of other investors to redeem their funds investments won't have tax implications on you. If the investors who have invested in mutual funds decide to redeem their investments, though, they will have to sell them back to the mutual fund company. And if too many investors start to sell at the same time, the mutual fund company might start to liquidate the underlying security investments to avoid losses. Now, something like that would have tax implications on every investor who have invested in that mutual fund, including those who aren't redeeming their investments. This is quite unlikely to happen, of course, but every now and then, depending on the investment climate, they do happen. So if you look at the tax implications and the tax efficiency, again, ETFs are a much better option than mutual funds are. If we take all this as a whole, after all this analysis we did on mutual funds and ETFs, where we analyze their similarities, compared how they're priced, how they're traded, how the funds are managed, how the costs work, and how the tax implications are, we can safely conclude that ETFs are in fact a much better investment than mutual funds are. This brings me to give you a quick tip on ETFs you can consider when investing. So firstly, you can start off by investing in an ETF that tracks the top performing companies in your country, like the S&P 500 in the US, which you already know now is known to exhibit impressive and stable performances through all phases of the business cycle. As for which S&P 500 tracking ETF you should invest in exactly, that is something you should choose for yourself by doing your own personal research. Going through ETF reviewers like Forbes Advisor, Investopedia, and NerdWallet are good resources to make use of for this particular purpose. Apart from that, you can also consider investing in a specific sector if you want to. So for example, if you're looking to invest in a defensive sector like consumer staples or energy, you can look for funds in that category like Consumer Staples Select Sector ETF, the Vanguard Consumer Staples ETF, the iShares US Healthcare Providers, or even Utilities Select Sector ETF. Now, these are just a few examples of ETFs in the US that were recently published but to be performing quite well. But again, please note that this is strictly not advisement or rather advice on investment that suggests you should make investments in specific ETFs. Like I always say, you should consider doing your own research on the options available and accessible to you depending on where you live and select your investments accordingly. Now, when you research on an ETF, make sure you research the 3 elements I'm going to tell you now to decide if that's something that suits your investment needs and goals, especially during a recession. The first is the fund managing company and the fund manager. The second is the performance of the fund during a crisis. The third is the expense ratio. Now, if we take the first element, ETFs or even investment funds being professionally managed is considered to be one of the biggest benefits of investing in them. But this becomes a true benefit only if the fund manager, who by the way can be one or more than one manager, is someone who strategically manages the fund towards profit with less exposure to the risks of loss. In other words, although a fund's performance may have a lot to do with how the market is doing, the manager's skill also helps to make the fund, or rather helps the fund to navigate through the market and beat its competitors or standard fund benchmarks. So if the fund manager isn't that sharp, the performance of the entire investment portfolio itself might be at risk. That's what happened to the Infinity Q's Diversified Alpha Fund, which was a mutual fund worth $1.7 billion. See, in 2021, this entire fund crashed because of the mismanagement of funds and some other unethical practices by the fund managers. This crash, rather, caused a massive loss for almost every investor that invested into it. So the first thing you need to do is to give consideration, and a great amount of it, when analyzing an ETF manager. And by that I mean you should do every bit of research on how the fund manager has managed the fund so far, and of course how the fund has performed under his or her watch. So a few questions you can find answers to are at what rate of return the fund manager earned year by year, and how she or he managed the funds during the market's ups and downs, especially when the market was fighting a recession. You can also find out what levels of risk the manager has taken and how the fund has performed against other comparable benchmarks and things of that sort. Now, generally all mutual fund companies have performance records audited and reviewed by the relevant regulatory authorities in their country. So for example, in the US, it's audited by the US Securities and Exchange Commission. And sometimes an individual fund manager also makes his or her audit reports available to investors. So going over these reports is a relatively good place to start on your research of the fund managing company and the specific fund manager. Apart from that, you can ask all these questions directly from the fund manager themselves. But then again, you need to be a bit more careful with that approach, because fund managers might pump up their numbers of the past performances simply just to impress you. For example, they might give you performance reports of only the accounts that did the best with and exclude the accounts of those that didn't. Or they might just give you the number of a time period where the funds performed relatively well. Or they might just give you the performance number with badly performing investments as indexes as benchmarks. Some others might even go to the extent of making up bogus numbers. So you need to be a lot more careful about this. The best way to reduce your chances of working with a fund manager who might try to play you out is simply by doing your own research. As always, check on the fund company and the fund manager's reputation. You can get personalized certifications and qualifications of the fund manager. You can always check on the previous customers' satisfactions, and you can always check to see if the fund company has liability insurance. If they did, at least that coverage will provide you some protection in case something big goes wrong. Then the second element that you need to focus on is the performance of the fund during crises. Now, this factor will pretty much be covered when you check on the fund manager and his managed funds performance, but the reason I have included this separately is that I want you to check on the history of the fund itself. And by the history of the fund itself, I mean checking on factors like how long the fund has been around for, how well it has performed over the years, and how did the fund do during past crises. The longer the fund has been around for, the better the performance it has exhibited. The more likely it is to contribute and perform well in the future as well. And by analyzing the fund's performance through different crises, you can gauge which type of triggers in a recession affects the fund the most. So in short, knowing these informations will give you important insights into the performance potential of a fund during all phases of the business cycle, including a recession, and will help you decide if that's an investment you want to make. Finally, the most crucial factor you need to analyze before you invest in an ETF is the expense ratio. Now, you already know that every investment fund has a fund manager working on it. And apart from that, there also might be other operating and maintenance aspects to the fund. So to cover all the expenses associated with these and also to make a profit, investment funds generally charge a percentage of your investment as fees. This percentage is what we call the expense ratio. As we already discussed earlier, the expense ratio of mutual funds is generally much higher than index mutual funds and ETFs, because more often than not, mutual funds are actively managed. On average, I think the expense ratio of mutual funds is 0.71%, while the expense ratio of index funds is only 0.5%. Now, this difference might seem very minor and so a bit unimportant. But the thing is, since these percentages are charged on the investment itself and not just the returns you make, they can have a huge impact on your overall net profitability. So for example, let's say there are two investors, Peter and Mark, who invest $200,000 each in an investment fund. Now, the expense ratio on the fund that Peter invests in is 0.5%, while the expense ratio of Mark's fund is 0.9%, meaning that the year Peter has to pay a management fee of $1,000 and Mark has to pay a management fee of $1,800 to the fund company. Now let's say both these funds generate a return of 5% at the end of the year. That's a profit of $10,000 per person. The investors, however, can't take the whole of this amount as a profit because of the expense charges they paid. So really the returns of Peter would be $9,000 while the profit of Mark would only be $8,200. That's a difference of 8.9% in profit per Peter and Mark, despite making the same amount of investment and also having the same amount of return. If the expense ratio was charged as a percentage of the investment and the profit earned, which some mutual companies tend to do, the difference in profit would be much higher. I mean, now do you see why even the small differences in expense ratios matter when accounting for investment returns, don't you? And who would rather want that, and not just now but during a recession, even during normal times, right? That's exactly why you need to give special attention to the expense ratio of an investment fund before investing. So if you get all that sorted, you can start investing in investment funds, more specifically ETFs.